welcome to This Explainer. Today, we're diving straight into the invisible trillion-dollar forces that dictate what your money is actually worth on the global stage. Have you ever looked at an exchange rate and just wondered why currencies strengthen and weaken seemingly on a whim? Well, today, we're going to unpack exactly why that happens, and trust me, it is a fascinating ride. To do that, we're taking a real zoom-out journey for This Explainer. We'll start with the banking tech revolution, take a peek inside the Forex market, figure out exactly why exchange rates change, tackle something called the impossible trinity, and finally, look at managing the float.
So let's kick things off with Section 1, the banking tech revolution.
Okay, so the evolution of modern banking actually started with simple telegraphs back in the 19th century, which, surprisingly enough, barely changed the industry at all. The real game changer wasn't the telephone, it was the advent of cheap electronic computing right after World War II. By the late 1960s, computer tech finally allowed machines to conduct point-of-sale transactions efficiently, and this gave rise to those sprawling credit card networks we all know and use, like Visa and Mastercard. Fast forward to the late 20th century, and boom, ATMs and online banking revolutionized the whole shebang, totally shrinking the globe and vastly increasing the speed at which capital can cross borders. Think about the visual irony of how we view banks today. On one hand, you have towering, classical stone buildings, like the Banque Nationale du Canada. And on the other hand, you can literally have an actual bank operating out of a trailer. It's kind of funny because even in an era of highly liquid virtual banking, sweep accounts, and instant digital transfers, human psychology still really likes to see those grand stone pillars. It makes us feel confident that our fiat money is safe. It might all just be digital ones and zeros on the back end now, but hey, we clearly still love a good Greek column. Moving right along to Section 2, inside the Forex market. Now, while everyday tourists get retail rates at airport kiosks, where you're essentially giving up more of your domestic currency to get fewer foreign bills, the real action is happening far, far above our heads. A few score of massive international banks are moving over $1 trillion a day in a highly efficient wholesale spot market. $1 trillion. They operate over the counter, which just means they deal directly with one another, trading millions at a time based on the spot exchange rate today. This market is so incredibly efficient that the rates essentially follow a random walk, practically instantly eliminating any rare arbitrage opportunities that happen to pop up. This brings us to Section 3, why exchange rates change. If you were to track the US dollar relative to the Canadian dollar over a 10-year span on a chart, you might think a line trending upward is a good thing, right? Actually, an upward movement there means the US dollar is weakening, because it's taking more of them just to buy a single Canadian dollar. These jagged peaks and valleys aren't just random static. They're actively driven by differences in inflation, interest rates, and productivity between the two nations. For instance, during the financial crisis, the US dollar temporarily appreciated in a sort of flight to quality. But as the 2010 recovery really took hold, it weakened again, eventually dropping back down to parity with the Canadian currency. We absolutely need to shatter the illusion of good versus bad here. A strong currency is not inherently good just because the word sounds positive. If your currency is strong, sure, it's awesome for you as a consumer buying cheap imported goods or traveling abroad. But it severely hurts your domestic exporters because their goods suddenly look incredibly expensive to foreign buyers. Conversely, a weak currency isn't inherently bad. It actually makes your domestic goods highly competitive globally, which is absolutely crucial for boosting exports and domestic production. The nominal exchange rate is honestly just completely arbitrary. What actually matters is how those changes affect a country's trade flow. All right, let's step back and look at Section 4, the impossible trinity. So the impossible trinity, also known as the trilemma, essentially proves that a country can only ever choose two of these three holy grails of international monetary policy at any given time. Think of it like a menu where you want the whole shebang: fixed exchange rates to stabilize trade, free capital mobility to attract global investment, and discretionary monetary policy to fight off domestic recessions. But no way, you literally cannot have all three. Look at the free float regime we generally live in today. You get your domestic policy control and your capital mobility, but you have to completely sacrifice fixed exchange rates. On the flip side, under the post-World War II Bretton Woods system, countries had fixed rates and policy control. But to get that, they had to heavily restrict the flow of international capital. History actually shows us that during major crises, nations willingly abandon their established standards. Great Britain completely dropped the specie standard during the Napoleonic Wars. And the United States, they floated their currency during the Revolution, the War of 1812, and the Civil War. Why? Well, because the impossible trinity basically forced their hand. In wartime, they desperately needed domestic monetary control to print money and borrow abroad, so they just gave up fixed exchange rates. This allowed them to fund their conflicts through a currency tax, which, let's be real, is just a polite way of saying inflation.
And finally, let's dive into Section 5, managing the float.
Let's look at exactly how central banks pull the mechanical levers today to perform an unsterilized intervention. This is how they manipulate their currency's value without committing to a totally rigid standard. If a central bank wants its currency to strengthen or appreciate, they start by selling off their international reserves, like foreign currencies or gold. Next, they receive domestic currency in exchange, which effectively removes it from circulation, soaking up the domestic monetary base. Finally, because there is literally less domestic money out there in circulation, inflation expectations drop, and each remaining unit of your currency becomes more valuable. Boom, the currency appreciates. Conversely, sterilized interventions are often just a short-term signaling ruse because they don't actually change the monetary base. Imagine a central bank buys foreign reserves with domestic cash. Normally, that floods the market with domestic money, causing depreciation. But in the sterilized intervention, they immediately offset this by selling domestic government bonds, essentially scooping that domestic cash right back up. Because there is absolutely zero net change to the money supply, it has no long-term impact on the actual exchange rate. It's really just a smoke signal to the market. A perfect real-world application of this mechanism is how China historically managed its currency. The Chinese economy was growing rapidly, which naturally should have caused their currency, the yuan, to appreciate. Instead, the government accumulated over $1 trillion in international reserves. How'd they do it? By continuously selling their own domestic currency to buy foreign assets. This massive unsterilized intervention kept the yuan intentionally weak and undervalued. And going back to what we learned earlier, a weak currency is an absolute superpower for an export-driven economy because it keeps your goods incredibly cheap for foreign buyers. To wrap up this explainer, we really have to look at the immense costs of balancing these monetary regimes and ask ourselves a serious question. As the relentless evolution of banking tech continues to shrink the globe and increase capital mobility, and as the trilemma constantly forces nations to choose between economic stability and domestic control, are we inevitably heading toward a single world currency? The European Union showed us it's possible with the euro, eliminating exchange rate friction entirely, but at the steep cost of losing independent monetary policy. Could the entire globe eventually make that exact same trade-off? It's a fascinating thought to leave you with. Thanks for joining me on this explainer.